All right, so with strong earnings overall and a recovering economy, it may seem like everything's going well, but one strategist says it's time to take a step back and de-risk. For more, we want to welcome in Emily Roland, John Hancock Investment Management Co-Chief Investment Strategist. I was really struck by this in your note, Emily. You said, everything is awesome. Maybe you should be a little suspicious, I don't know, of that kind of, when everything looks this rosy. Why does that give you pause, and what do you want to do in reaction?
Yeah, Julie, I had a feeling you might choose that one very last sentence I wrote in my notes to hone in on. But, we're looking at this environment where everything, first of all, has gone really well for the Fed. We've had a period where growth has seen a modest reacceleration. The labor market remains really robust and resilient in the face of higher interest rates. And at the same time, you've seen disinflationary trends continuing. The Fed, of course, wanting to see a little bit more in order to confirm that inflation's coming down, but everything's going really right today. And then you're also seeing, as you've mentioned, earnings growth picking up. Expectations at the start of this quarter were for negative earnings growth, and now we're about 2/3 of the way through Q4 earnings season, and we're looking at almost 3% earnings growth. Of course, that's been concentrated, as you guys mentioned, in some of those mega cap tech names, but there's a lot of things going right. And when we look at the market dynamics today, areas like small cap equities are really perking up, and looking underneath the hood, there's a lot of crypto related assets there. So it feels like there's a lot of risk taking going on. Sentiment is getting, maybe a little bit ahead of us here as everybody continues to celebrate disinflation, better earnings, again, reaccelerating growth. And it's not that we don't want to participate. We do. We want to be invested in this market. We just want to be mindful about going over our skis and taking risk.
So Emily, so you do want to be invested. So given that backdrop, where in the equity market do you want to be invested? Where do you see value?
Yeah, so we've continued to have an emphasis on U.S. Equities over international. Again, economic growth holding in the best here across the world. We can see that through business surveys. We can see it again through labor market dynamics. We also have a preference for quality. These are companies with great balance sheets, lots of cash, low interest burdens, better pricing power. And if you want to own quality stocks, frankly, the poster child for quality is mega cap tech. And you're going to find a lot more of that, of course, in the United States than you are elsewhere. Now, the problem is that mega cap tech's gotten pretty expensive. In fact, if you look at the S&P 500 growth index, it's now trading at a 45% premium to its 20-year average. So there's a valuation issue there. The stocks can continue to deliver if their earnings are there, which so far they have been, but there does come into question, when do valuations kind of, cause us to take a bit of a pause? So we want to diversify away from tech, even though we still like it, by owning areas like U.S. mid-cap stocks, which are actually trading at almost a 30% discount to their large cap counterparts. And we see them benefiting from more secular themes around onshoring. We like the overweight to industrials as a way to play a lot of this fiscal spending that continues to happen in the United States.
Emily, I think your point about large cap growth is quite interesting here. And I just want to kind of linger on that for a moment, because I think a lot of investors right now, particularly in the wake of what was a mixed earnings season for the so-called Magnificent Seven, the largest of those mega cap tech companies, people are asking themselves, okay, now what? Do I hold it? Do I lighten up? Do I buy more? And it sounds like you're sort of in the hold camp, if I'm reading between the lines here. Is that effectively what you're telling investors? Hold on to those, but do some other stuff too.
It's hold broadly, but I want to make it clear that the Magnificent Seven, they come from different sectors. So you've got your traditional technology, S&P 500 tech sector, then you've got communication services, and then you've got consumer discretionary. So those 7 stocks are actually spread across those various sectors. What we would be doing is looking underneath the hood at where can you find quality within those sectors. And frankly, the classic S&P 500 tech sector ranks the highest on the quality metrics that we look at. So that's really where we would hone in. So maybe it's not about owning every single one of them. Maybe it's the Mag 5 or 4, or I'm sure we'll come up with some new name for it here in the future, but digging underneath the hood and finding where there's an overlap with quality and tech.
And Emily, I'd love to get your thoughts on China as well. I don't know if you heard, I was talking about that with Julie as we started off the show, and it's been hard to, Emily, kind of find a common narrative during this earnings season. It really does vary widely depending on the company, the sector, the industry. We'd love to get your thoughts on China. Do you want exposure there?
Yeah, we've been minimizing our exposure to China and emerging markets for a number of reasons. There's continued challenges with their property sector being over-levered. There's a kind of move away from capitalism as there's more control over many companies in China, which is less business friendly. So we've actually been, taking that underweight to emerging market equities and taking that into the United States, particularly by allocating to mid-cap stocks, which are benefiting from some of those supply chains in China actually coming back to the United States. So that's been an underweight for us broadly. In terms of other earnings themes, you guys nailed it earlier, talking about some of the cost cutting and restructuring in general that's happening. And what we're seeing is pretty typical dynamics for a late cycle environment where revenue growth is normalizing. It was explosive during the height of the pandemic as we pumped $5 trillion of stimulus into the economy. And companies are now contending with a higher cost of capital as the Fed raised rates. So margins are starting to compress. So something we've been waiting for a while to happen. And if you're a company that wants to maintain profitability and your margins are shrinking and you can't raise prices anymore, you have to cut costs. And that's the way that a lot of these companies are really generating their profitability and beating those earnings estimates. So I think another notable trend that's playing out.
Emily, finally, I want to ask you about the Treasury market a little bit. It's been a big week for auctions, Treasury auctions. Today, there was a 30-year auction, and there's been strong demand for that all week, although we are seeing prices fall off a little bit today and yields go higher. What are you expecting that dynamic to continue to look like, and what do yields look like in the short term?
Yeah, it's a great question. And supply-demand dynamics can definitely play a role in moves in Treasury yields over short periods of time. And I think we've certainly seen a little bit of relief here as the markets absorbed some of those recent auctions. I think yields are backing up today on higher oil prices primarily. So I think there's other dynamics at play there. Over time, we see demand as being a more important part of the supply-demand equation as it relates to treasuries. So I think what you'll see is as we see a further deceleration in the economy going into the remainder of 2024, you'll start to see investors thinking about de-risking and embracing treasuries because, of course, that's one of the safest places that investors can go. So we think even though there may be some continued concerns around supply, that demand will come the overriding factor.
Emily, thank you so much for helping us kick off the show today. We always love having you. Thanks again.
Thank you.